today, October 12th, Boston Scientific dropped 4%. And you can see yesterday was also a very steep drop. And so in just 2 days, we can see that Boston Scientific has already dropped 9.5%. So is Boston Scientific stock crashing? In this video, we will review the unusual options activity data to find out what is happening, because we detected some unusual options today and we traded it based on this data. So without further ado, let's get to the data as usual. Here we are. This is the options time and sales tape. We can see here that about 20 minutes before the market closed at 3:42 p.m., somebody bought 2,080 option contracts at the 50 strike calls expiring November 17. Okay, and they paid $130 each. So what is that in value? Total value, $130 each, 2,080. And so this trade was about $270,000. This one trader. However, also we may want to add another 520 contracts, since this was also done at the same time. This could be the same trader. Okay. So keep that in mind. It is at least 270K. It isn't over $1 million, so this trader is not did not spend in the millions, so they may not be as confident as in the price stock movement as some of the wealthy traders that we usually follow and put a larger position size, because they can predict the stock price movements a lot more accurately. If you are interested in this type of data, make sure to join our channel homepage, where we share exclusive videos to our members based on the unusual options activity. And so click the join button if you do want to join on our channel homepage. So when we take a look at the November 17s, we can see here on the option chain, this is 36 days away. And we can see here that there was 50 strike calls, 3,000 total volume today. We know these are opening trades because these are the 3,000 is larger than the open interest of 500. Okay, so even if that one trader bought all of these 3,000, which we know they didn't because we are also in the position, and so that's not possible because we also got in on this trade. Let's say it was about 3,000. You can see that, and they paid 130 for each. This is still about 390,000, so not $1 million yet. And so that's why we did not put in a very large position size, but we did trade it. And the way we traded it is that we bought the 50 strike calls, but we also sold the 52.5 strike call. So when you analyze the trade, you can see that this is our trade. And you can see that our deltas, the Greeks, are over here. We have a positive 21 delta, and we have a slight negative 0.89 theta decay. Okay, so the risk is this theta, the options value will decay in value as time goes on. All right, so the reason why we didn't trade this exact same options as the unusuals is because by buying these 50 strikes, when you analyze this call option, you can see here on the Greeks here, this theta decay risk is a lot higher at negative 2.56. So this option would decay in value much quicker than our option strategy. It does have a higher delta, so that is what the trade-off is. But the way we want to trade, because this isn't a very highly valued in the millions, we do not want to take such a large risk. We want to reduce our risk, and so that is the way we trade. We want to reduce our risk, and that's how we beat the market, by maximizing our profits in this way, right? And so this is our trade here, and you can see that we are risking about $78 each. You can see that the cost of our trade is $78. In comparison to those call options, if you were just to buy them, they're actually more expensive at $125. So even though you may be getting that larger delta at 40, you're paying more. And so delta is something you can pay. You could essentially get two contracts, or two of these trades that we got into it, and also get more delta, of 40 delta as well. Right, so that's something to keep in mind. You can see that the risk of $78 per contract trade, and we have a max profit here, 172. It could make a potential of 172. You can see that max profit at the left side of the screen at expiration. So that risk to reward ratio of 172 divided by the 78 of the initial cost is a 2.2. So it's potentially possible to make 220% on this trade. So we like that about this risk to reward ratio is more favorable to us also. And so that is how we're trading this based on the data. And so to answer the initial question, we don't think Boston Scientific will crash. There is a good chance that the short sellers who have been shorting Boston Scientific will now start taking profits. And in order for them to take profits, they have to buy to close out their position, because they sold to open and now they have to buy to close. And by buying it, has a good higher probability of this bouncing back up when they buy to close out their short positions after this sell-off here in the past 2 days. Keep in mind, earnings is also coming up. So these trades are also going to have this earnings risk as well. And so if you are interested in how we trade using options to reduce our earnings risk as well, we also share our option strategies to our membership as well. So click the join button if you're interested to learn and to see how we trade options to maximize profits and ultimately beat the market. If you're not beating the market, this data is very helpful in turning things around, because the data does not lie. And if you've been following this channel, you can see many instances in which we've been very profitable. And the ones that are public are just a fraction of our trades. Most of the trades that we are actually in, where we put larger position sizes in, are shared to our members. All right, take care, everybody, and hope this was helpful. Please smash that like button, subscribe if you haven't, hit the bell icon to get notified whenever we detect unusual options activity. Thank you and take care.